Yeah, good day, guys. And how have we been doing? Yeah, you're welcome to my YouTube channel, Having Forex. My name is Sunday. Today I'm going to be teaching us trading the pin bar candlestick with the trend. What does that mean? Pin bars, how to trade pin bars using trading it with a trend. When there is a trend, be it uptrend or downtrend, for you to know where you are going to place your entry point, usually there is usually what we call pin bar. Pin bars are a price ejection. When price trends to a certain level and price action will reject it and it will move opposite direction. So today I'm going to be, teaching us how to use pin bars to trade trendy market. If you are a beginner in the forex market, I highly recommend you stick with the trend because it's very important as a beginner you start trading with trend because you don't have the capability, the experience to counter trade or even range bound market. So it's very key and it's something that you must learn, to stick to trading market. You only trade as a beginner, it is advisable for you to only trade when you see a clear uptrend or a clear downtrend. So if you are a beginner in the forex market, I highly recommend you stick with the trend because pin bars that occurs in the trading market offer good trading opportunities with high risk reward ratio. Because by the time you see a trending market, be it uptrend, downtrend, like I said, once you see a pin bar that is in the right direction, in the direction of the trend, it's worth trading. It has this high risk reward ratio. In my previous video, I have explained to us what high risk reward ratio is. It means that you can see the possibility of trading 2 to 1. What do I mean by that? Your target point is twice as your stop loss point. When you place an entry, first thing you need to check for is where you should put your stop loss. Stop loss will act as a protection to your trade in case your analysis go wrong. Once it gets to that point, that level where you put your stop loss, then it will take you off the trade. It will prevent you from losing money. Instead of you to continue to lose money, that is why stop loss comes in. Stop loss is what you set as soon as you maybe you might not be there, and your analysis that you carried out, you might feel, oh, you are right, you have every confirmation and all that. But mind you, there's what we call supply and demand. So sometimes that could prove you wrong because if there is higher supply or higher demand, the market will change. So that does not mean that your analysis was wrong. Sometimes it do happen, when there are too much bias, the market will move in the opposite direction. And when there are too much sellers, the market will move again in opposite direction. If plenty of sellers have already set uh, their order, if they have already placed their order waiting for price action to get to a particular level, as soon as price action gets to that particular level, those orders will be activated and automatically price action will turn to that direction. Most especially where we have all the banks, financial institutions, and all that. Once they place their order, as soon as price action gets to that place, it will activate and move to the direction they want. So that is how it is. So you always use stop loss to protect your trade. So that is how it is. When you master trading it with the trend, you can then move to trading rate bond market or even counter trend. So the first is for you to learn how to trade pin bars in a trending market. Thereafter, if you now see that you are now perfect, you can now try to trade it with a range bound market or do a counter trade, For example, when a trend is trending, when a price action is trending up, then you know the point. If there is an impulsive move, by the time you want to do a retracement, you can place your order and retrace with it so that you make profit again. So it's very tactical. That is where we need to know how to plot what we call Fibonacci retracement. You know where the retracement will start and you know where it will end. You understand? So that is how it is. So it is advisable for us to first of all know how to trade pin bars with the trend. Thereafter, if you now see that you are now, getting perfect, then you can now try it with a rainbow market or do a counter trend. This strategy is simple. Like I told us, trading, forex trading is a very simple thing. But in as much as I just use the word simple, it does not mean that it's simple. You have to learn it. By the time you know what you are doing, by the time you are now grounded, you now discover that it's very simple. And I always advise my students that keep everything simple. You know, don't don't try to apply all the strategy. Just choose one strategy, master it, and you run with it. So that is how it is. The strategy is simple. You start by identifying a clear uptrend or downtrend, and you wait for a pin back to occur after a pullback to support or resistance level. The figure by my left here now shows how this price action signals works if it is traded with the trend. See, the price was rejected from the resistance level, which indicates that the BS are still in control, are still taking control in the market. That is a downtrend. You can see from here, this is a downtrend. This point here is a resistance level. Okay. Then, as it was coming down, you now see how the market moved like this. It came back to retest this place again. It was coming down, it was supposed to go down like this, but it reversed like this. Here, it started retracement. This place, you see, this retracement move. here there was a rejection there. You see it going backward. Then it now gets to this place. This is a resistance level. Here you see this pin bar. Got to this point, there was a rejection. Here you see price action pull up to this point. But before this candle closed, there was a rejection. The bears rejected it down. At the end, it now continued to go down. This is what we call payback. Now you can now see that there was a pullback. This is a retracement. You can see anytime you hear retracement or pullback is the same thing. Pullback or retracement. That is when a price action is going, either is going down at a point, you now see it coming up. But it will come up to a level, then it will start going to that same direction down. But if it is going up before trending up, but at a point you now see it coming down a little, it will come down a little, it will retrace a little, there will be a pullback a little, then it will start going. But once it makes that pullback, just here like now, it makes this pullback before it will continue going down, there will be a rejection at the support level or a resistance level. This is a resistance level now. In this case, this is a downtrend. Here it made the retracement. It got here. There was a rejection. This is a pin bar, clear pin bar. Now, if you have not, if maybe let's say for example, you've not entered your trade from this area, and you now notice, okay, there's a retracement. You wait for this, you wait for the retracement. After the retracement, you now see a pin bar. Here, after this one close, as you see this bearish engulfing, you can place your order and you will just ride with the trend. It's very, very simple. But what you have to bear in mind is that these pin bars can appear in any areas, but the ones that are most important for you to trade as a strategy is at the key levels. Key levels. Key levels. Key levels are resistance level, support level, demand and supply level that I've already taught us. If you watch my video, if you don't know what all these things is all about, watch the previous video. Now, the formation of the pin bar indicates the end of the retracement move, like I showed us, and the beginning of the impulsive move at the resistance level in line with the downtrend. When you check that the downtrend that I showed us just now, you see that the rejection happened at the resistance level, not at the support level. You understand? Let's say, for example, this very one, now this is an uptrend. This is an uptrend. You see, impulsive move, a retracement. Impulsive move, a retracement. Now, this is a retracement here. You now see a pin bar. You see a pin bar. There's a rejection here before you start making another impulsive move again. This is what we call pin bar. Let's say, for example, all this area now, you were not able to enter. You were not around to enter. You didn't, place any trades before price action gets to this point. As soon as you see this pin bar formation here, you wait for it to close. Then the next bar market, which is this bullish engulfing candle, place your entry and you ride with the trend. That is how it is, because it will only go up, make an impulsive move, a retracement, impulsive move, retracement, impulsive move, retracement. It will just be going like that. This is a high quality setup because all the following criteria are respected. For example, the pin bar was well formed. This one was well formed and it is in line with the direction of the trend. What do we mean by direction of the trend? The trend is going up and the rejection came from the support level. It came from the support level. There was rejection here from the support level. It's not, this one now is against the trend, so it does not really, it's not important. When you see something like this, it's not important because the current trend is an uptrend. That is the trick there. That is the knowledge you need to acquire there. If it is an uptrend, pin bars that you'll be looking at is always at the support level. But if it is a downtrend, you look at pin bars at resistance level. It's like that. Keep it simple. It's very, very simple. You don't have to crack your head, you know, for nothing. It's simple. When you see a clear pin bar, you see a rejection here. Now, this is 21 moving average. That always acts as a dynamic support or resistance level. If it is uptrend, it will be acting as a dynamic support level. If it is a downtrend, it will be acting as dynamic resistance level. You see, when the price action got to this place, it broke through a little, then there was a rejection. It rejected it. Then the price starts, trending again. The rejection occurred in a major key level, represent a hot point in the market. The risk to reward ratio is good and it is worth trading. Secret behind formation of pin bars. As you can see in this chart, price action was trending down using the 21 moving average. Price action was trending down. Using the 21 moving average will help you to identify dynamic resistance level and alert us on high probability pin bar setup. You can see here, this is a downtrend, But when it got here, there was a rejection. That means that a retracement is about to happen. This is a rejection. This rejection now is against the trend. Against the trend is coming down. Then you now see a pin bar form like this. This is a pin bar. But this one signifies a retracement. So if you want to trade counter trend now, you just place your trade here. But you need to use Fibonacci retracement tool to be able to determine where the retracement will stop. Otherwise, it will now, if you are not able to identify where it will stop, by the time it gets to a point where it will stop, you now see reversing. And what will happen? It will hit your stop loss and take you out of the trade. So that is why counter trend is risky, but once you are familiar with trend and you know how to navigate your way, you can do a counter trade. So here you see there's a rejection, then it signifies a retracement, a pullback. Then I immediately got to this place, 21 moving average. It broke through it a little. It's fake out. Don't think it's going, it's fake out because the trend is downtrend at this point, except when it tells us otherwise later. So there was a retracement, and when it now got here, there was a rejection. This is the pin bar pin bar signal in line with the downtrend. This is it. Once you see it like this, place your entry, then you roll with the trend. It's very simple. The chart on my right shows us how the 21 moving average could help us find key points in the market, just like I've just showed us. You see, the 21 moving average is acting as a resistance. The one that I showed us before was an uptrend. The 21 moving average is acting as a support, a dynamic support with the trend. All you just need to do for you to have this one here is for you to just activate it. It's simple. I will show us by the time we start, by the time we get to a point where we will now start practicing what you've learned so far. It's just for you to activate it and it will start guiding you through as you trade. When price approach the moving average, the buying pressure takes place in the market and the price goes up. So what usually happens when you see um, um, a pin bar like this is that as price approaches this level, this moving average, now there are so many people that have already placed an order. We have types of order. All these things I will teach us as we progress. We have an act market. An act market is something, is an order that you just place and you are in the trade immediately, instantly. Instant order. It's like an act order is like an instant order. It's an instant order. You just place, telling your broker you want to get in. And this thing is not something that maybe you carry your cell phone to call the broker. It's an application. As you click place an order, the software will just activate your order instantly. And we also have what we call buy stop order, and we have what we call a sell stop. So by the time you place a buy stop, for example, the current trend is coming down. Then you know with your analysis that after a while, it will come up. Just like you open your chart and you see what the price, what price action is doing at that moment is a retracement, for example. Like from here, the current trend is a downtrend. Then open your chart and you see it here that the thing is retracing. It's retracing. Now, maybe you don't have time to wait until it fully, finish the retracement or the pullback. All you need to do is that you will now come and place a sell order. By the time you place a sell order, it's going bullish, but by the time you place a sell order, it will go back, it will finish the pullback. As it's coming down, it will now, by the time it gets to that your order, it will activate it. Then it will put you into the trade, even if you are not there. So that is what order is all about. The sell stop order. Then we have the buy stop order. The buy stop order is, for example, you open your chart and you see a trend, a retracement backward. That means a trend that is an uptrend, but at the time you open your chart, you see that the price action is retracing downward. What you need to do is you place your order. Let's say, for example, let's assume this is a retracement. Let's assume this is a current trend that is going up. Now, you got to this point, you now see a retracement. It's coming down instead of up. It's coming down. Then you open and you now do your analysis. You discover that, oh, this is just a retracement. It will start coming up like this. All you need to do is to place your buy stop order here. By the time you finish retracing, then it will start coming up. By the time you get to where your order is, it will activate it and put you in the trade. So all these things you see, rejection from here. All these are orders that people have already placed there. They've done their analysis. They know that price action will retrace by the time you get to this level, it will retrace. By the time you retrace, it get to this point, it will activate so many orders, 1001 orders are waiting. So as soon as it gets there, it will get a rejection. It will trigger all the orders in, then get a rejection and start coming down. So it's like that. It's very, very interesting. If you know how to trade this thing, it's very simple and interesting. So when price action, when prices approach the moving average, the buying pressure take place in the market and the price goes up. So it's like that. By the time the price action gets to that, a certain level, it will activate orders that are there. Then you see the price will start going up if it is an uptrend, or you see it going downward if it is a downtrend. The pin bar signal is clear on the chart. You can see it's very, very clear because the trend is bullish. The price action setup has a bullish anatomy as well. And the rejection from the 21 moving average is a confirmation signal to buy the market. Now, by the time you see this is a downtrend. By the time you see an uptrend, you see a rejection from 21 moving average. Like I told us, if it's an uptrend that I showed us before, an uptrend, the 21 moving average will be acting as a support, a dynamic support. So price will always reject as soon as it gets to that 21 moving average. But it is not as if anytime it gets there, it will reject. But there will be at times a point where it will break through it. Like I told us, if buyers are much, the price will go, the price action will go bullish. If the sellers are much, the price action will go bearish. So it's like that. And don't forget, we also have financial institutions, those people who, like banks and all that, they have the money to tell the market where it should go. Once they put millions of dollars or pounds into it, they will determine where the price action should go at that moment. But by the time anytime you see them trading, they don't stay long. They'll just come, boom, take whatever they want to take, and they are out. So it's like that. It will come as a bomb. So now, after we have identified the trend, uptrend or downtrend, and the levels, the support or resistance level, the next thing we need to do is for us to find a pin bar near these levels in line with the direction of the trend. The second step is to know how to enter the market based on candlestick pattern. By the time you see something like this is a pin bar. The next thing you should do, you should know is when and how to enter. Because as soon as this bar market closes, there will be another, you have to watch out for another one. Sometimes it will reject, but if the pressure of buyers are much, it will go up. That is it. As it like here now, a retracement meaning that there were orders here. Some people predicted that, they did the analysis and they predicted that at this support level, price supposed to go up, supposed to start trending up. But the orders here, they were lesser than the orders that are here. So as the orders that are here now triggers it to continue going downward again. So it's like that. It's very simple. By the time you see something like this, a pin bar like this, the next bar market, there's what we call lower low, lower close candle, higher high, higher close candle. Don't worry, I'll teach us all those things. All these are strategies. All these my strategies that I'm just revealing. All these are strategies. Now you see this candle. This one now will gap down. It's lower. It closed lower than this. This one closed lower than this. So for you to be sure, as soon as you get this rejection, you see this rejection, allow this one to form again. And once it start forming, allow it to close. As soon as it start closing, as soon as it close, just place your entry before this one start going up, and before this one start forming. So, or you can still wait for this one to start forming. By the time it closes, it's a confirmation that it's a clear downtrend. It's going down again. So it's like that. With my experience as a price action trader, there are different entry options when it comes to trading pin bars. It all depends on the candle anatomy, which is the story behind the formation, the market conditions, the condition of the market at that point, and your money management strategy. How your money management strategy. So at this point, I will stop here because too much of information, people don't have the the patience and the mind, you know, to carry everything out at once. It is better, we just keep dishing it out gradually, bit by bit, so that we won't get tired. Because this thing is it's a profession on its own. As simple as it is, it's a very, it's a profession on its own. And it's not, if somebody tells you how you learn how to trade one day, that is a lie, you know, because there are so many things you need to learn, so many things. And this is the time you need to learn it, study it, put it in your head, practice it. By the time we get to the level where we will now start practicing, then we'll now start practicing all those things that we've learned. Because it is not advisable to just create an account and start, because by the time you start practicing, you won't even have time to learn. So you need to get the basics first, get the foundation first. Then before you get into the platform, because it's fun when you start trading using a demo account to practice. It's fun, so that you won't just go there and start playing. You don't think that it's trying your luck. No, you have to apply a strategy for you to be able to navigate the forex market. It's simple, but it takes time for you to learn it, master it before it now becomes simple to you. Now, if you are just into it, it's very, very brain draining and time consuming too, because you have to, start. You have to spend much time, to study your chart, learn candlestick patterns, the anatomy, the story behind each candlesticks, the names, what they represent, how you can able to, apply it in real life, and all that. And another key issue is risk management. You need to be very, very, solid in risk management. You don't just do things, try your luck. No, you have to be able to do analysis that will tell you, because there are some place where you want to place your trade. You see a good signal, but there's no place for you to put your stop loss. If you try to put your stop loss, it's too much. The gap is too much. So you cannot afford to take that kind of risk. So if it happens like that, you just let that opportunity pass you by. Because by the time you place your trade, you must have done your analysis, place your trade. If where you are supposed to put your um, stop loss is too long, the distance is too much, maybe about 50 pips, 70 pips. No, it's too much. At least like 10, 15, 20 pips, it's okay. Let's say, for example, this a rejection, and I want to, this is a rejection, and I see that, okay, with my analysis, this is supposed to go bullish. There will be a change of character here. That means it's supposed to go bullish. Now, as soon as this one closes, I will want to wait for this one to close before I enter for confirmation. Now, if you place your trade here, that means your stop loss will have to go below this pin bar. This pin bar, your stop loss, where you put your stop loss will be below this place. Then by the time you now calculate the pips between here to this place, if it is more than 20, 30, my brother, it's not worth trading. But something like this is still okay. But if you now get, let's assume this is where you get a rejection and price action is already here, somewhere here. And you now want to enter. This place, the distance between this place and where you are supposed to put your stop loss is the distance is too much. So all you need to do is just allow it to roll, wait for another retracement. So that is how to, you have to be risk management conscious. You need to know how to manage your risk. So on this note, guys, I thank you for watching this video. Thank you for your support, and all these materials I'm releasing, I take my time to to put all those things together just for you to have the knowledge. Financial market, it's a market where anybody can make money, provided you have the basics, you learn it. Don't just jump into it. You have to learn it. You understand? It's a discipline, it's a field on its own. It's something that you need to learn before you start, practicing it. So no matter the time it takes you, you just have to be patient to learn it before you venture into practicing it. Good 18, there is what we call demo account. You can be using demo account to practice. Yes, it's okay. Demo account to practice while you are still learning. Demo account to practice, you demo trade, you are still learning. Demo trade, you are still learning. You read and all that, and even do your own research, even more research on your own. I tell you, before you know it, all those things, you just be playing with it and be making money and be playing with it. So it's like that. So on this note, I will say thank you guys very much, and all these materials, try to study them. Hit the like button, subscribe to my YouTube channel, share it to your friends, your family, anybody. You just share it. You have any platform, share it. Who knows? There are people who are, they are interested in, going into forex market, financial market, and they don't know how, So share it so that the videos, all those materials will get to the people that really need them. Thank you so much, and I see you guys in the next episode. Bye.